Welcome back to US Tax Unpacked, where we make sense of America's ever-changing tax system. If you've ever looked at your paycheck and thought, wait, why is my tax bill still so high? This one's for you. The IRS just released its official inflation adjustments for the 2026 tax year, and the numbers will affect every working American. We're talking about bigger standard deductions, wider tax brackets, and how those small percentage changes might save you hundreds, even thousands, next filing season. So grab a coffee, hit that like and subscribe button, and let's unpack what these new 2026 tax brackets actually mean for you. So, why this update matters. Every year, the IRS adjusts income tax brackets and standard deductions for inflation. It's their way of making sure rising costs don't push ordinary taxpayers into higher tax rates. For 2026, those adjustments are the largest since the pandemic years. That means most people will pay slightly less in tax, even if their income goes up a little. And these changes are official. They come straight from IRS Notice 2025-50 released this October. So whether you're single, married, or head of household, the math is shifting, and it's in your favor. Let's start with the standard deduction, the amount you can subtract from your income before calculating taxes. For 2025, the standard deduction was $14,600 for single filers, $29,200 for married couples filing jointly, and $21,900 for heads of household. For 2026, the IRS increased those to $16,100 for singles, $32,200 for married couples, and $23,250 for heads of household. That's roughly a 10% jump, meaning more of your income is protected from tax right from the start. For example, a single worker making $60,000 will now be taxed on $43,900 instead of $45,400. Now here's how the 2026 brackets look for single filers according to IRS Notice 2025-50. 10% on income up to $12,150, 12% up to $49,300, 22% up to $104,350, 24% up to $193,100, 32% up to $243,725, 35% up to $609,350, and 37% above that. Compare that to 2025, where the 12% bracket stopped at $47,150 and the 22% at $100,525. So even though wages might rise slightly, the higher thresholds mean more of your income stays in the lower brackets. That's what we call bracket creep protection. For married couples filing jointly, the 2026 brackets now double the single amounts. 10% up to $24,300, 12% up to $98,600, 22% up to $208,700, 24% up to $386,200, 32% up to $487,450, 35% up to $731,200, and 37% above that. Last year, that same 22% bracket capped at $201,050. So couples get about a $7,000 wider cushion before moving up a tier. If both spouses earn around $75,000, their combined taxable income after deductions could actually land them in the same bracket they were in last year, despite earning more. That's a quiet tax cut. Let's talk about heads of household. For heads of household, it's often single parents or caregivers. 2026 brings meaningful relief too. The standard deduction climbs to $23,250, and the 22% bracket now extends to $156,500, up from $150,000 in 2025. That means families raising kids on moderate incomes could see a few $100s back in refunds or lower withholdings. When you're balancing groceries, rent, and school costs, those extra dollars matter. Now let's put this in perspective. A single worker earning $75,000 paid about $9,800 in federal income tax for 2025. Under the 2026 brackets and deductions, the same person would owe roughly $9,300, a savings of about $500. A married couple earning $150,000 combined, their tax drops from roughly $17,400 to about $16,700. Another $700 back in their pockets. And a head of household earning $90,000 would save around $400. These aren't life-changing amounts, but they add up. And they show how inflation adjustments quietly work in tax. So what should you do with this information now? First, check your W-4 at work. You may want to adjust your withholdings to match your new bracket for 2026. Second, if you're self-employed, update your estimated quarterly payments so you don't overpay. Third, review your deductions and credits. Charitable contributions, IRA contributions, and medical expenses might look different when the standard deduction increases. A little planning now can prevent both surprises and refunds that are basically interest-free loans to the IRS. What are the other inflation adjustments? IRS Notice 2025-50 also raised thresholds for dozens of other items. The Earned Income Credit, Child Tax Credit phase-outs, and retirement plan contribution limits all move higher for 2026. For example, 401k contribution limits are expected to rise to $24,500, up from $23,000. And the income limit for Roth IRA contributions will increase to around $163,000 for singles and $326,000 for joint filers. These incremental shifts mean you can save more tax-deferred money and still qualify for credits you might have lost under last year's thresholds. What this means as a big picture: when people hear tax cut, they think of Congress. But most of the time, it's inflation adjustments like this that make the real difference. The IRS simply adjusts numbers to prevent what economists call bracket creep, where inflation pushes your income into a higher tax rate, even though your buying power hasn't changed. So while there's no political drama here, these annual updates quietly protect your paycheck. And with inflation still sticky, these 2026 adjustments are particularly generous, worth knowing and planning around. So there you have it, your 2026 tax brackets, standard deductions, and what they mean for real people. If you found this breakdown helpful, give this video a thumbs up, share it with a friend, and make sure you're subscribed so you don't miss our next episode, where we'll unpack how the IRS plans to tax digital assets and crypto income next year. Until then, stay smart, stay compliant,